Hi everyone. So today will be your seventh class, and so this is your specification here. So we'll be mainly covering the learning outcome 6. We have covered up until 5. We've discussed about the different types of risks and so on forth. So today we will be looking at the risk mitigation techniques. The risk related to in context of the global, the international markets. So we will be looking at all of that. In the last class, we looked at some part of it, like the capital asset pricing model and the cost of capital, the weighted average cost of capital, exchange rates, interest rates, and all of that. Today, we'll be mainly focusing towards the risk mitigation. So that will be the main focus today. And I will be also showing you guys a video at the end of the session, most probably, because that's about risk management. That's more of in a general context. So I feel it would be better to show you guys that video too, so that you guys will be aware of the complete picture. So that will include some part of the discussions we've had before and we have now, and then some extra details as well. Okay, so today's class will be about the learning outcome 6, covering those assessment criteria and the contents related to that. Right, so here we'll be looking at the risk mitigation techniques. Okay, right. So I'm going to read this for you guys to explain. So far, we've covered up the different types of risks and the calculations and um, the risks in terms of the national and the global markets, the global risk where exchange rate risks involves. Because when it comes to risks, in an organization point of view, risk is something that cannot be avoided, right? Although it can come as part of the strategy, but you cannot completely ignore an element called risk. That is unlikely. So you need to be acceptable that if you are running an organization, if you have a business in hand, you are going to face some sort of a risk in some means. Either it can be in small scale or it can be a large scale organization, or your risk element could be something related to short term or it can be long term. But there is always a risk in every decision being made, because there's always a pros and cons. There's always pros and cons. So in that case, there'll always be a risk. But the overall goal of an organization would be to work on, to understand, to work on the risk and to eliminate it, in which sense they will come up with strategies to overcome the risks that would be addressed, and then finally achieve the goals of the organization. So that is actually, to some extent, it is, how do I say, that's a challenge, right? Every business would actually want to go through such a thing. If a business doesn't go through such a thing, then that's going to be less wise as well. However, it's very unlikely there would be a business without any risk involved, because it can be even maybe financial, maybe resources point of view, maybe they do not have the required resources in terms of, labor. They do not have the required labor, or they might not have the relevant finances, because we were discussing in the previous classes about the ways in which the funds could be gathered. It can be long term, short term, those implications. So there could be risks involved in that, or even the product itself they produce. Like I said in the last class, there it's about the taste and preferences. In case if the taste and preference goes down, then that's going to be a problem. So you cannot have one thing in mind, but rather you need to have so many things in mind for you to make effective decisions, right? So these are certain parts of it, in terms of risk. So let's look in detail. So I'm going to read this as usual. We're going to read and then work on the elements. Okay, right. Managing risk is one of the main concerns every business has. The strategies used in risk management techniques would depend on factors such as the industry, the market share, resource management, and also the internal capabilities. Right. So the risk management strategies, so they're talking about the risk management strategies here. They're talking about the ways in which it could be managed. So it's just not about the manager deciding what needs to be done, but instead it would depend on so many other things. So many other things depends on factors such as the industry, the market share, the resource management, and the internal capabilities. So all these play a very important role when it comes to risk management. For instance, you have the manager there and he's very well in decision making. He analyzes, he does everything and makes really good decisions. But in the event where you do not have the right resources in hand, for example, you do not have the required level of human resources, or maybe you are putting up the plan, but however, in order to implement it, you need 2 3 people, you need more than what is available. So in that sense, what do you do? So there is a problem there, so there is a risk element there, so that needs to be managed. Okay, so this is what is really important to understand, because without a proper analysis, a business cannot come up with any strategy. So we've been looking at this quite some time. We've been looking at this element for some time now, from the time we started the classes, right? So it's very important for you to understand the connectivity too. So when it comes to the strategies of managing risks, so it can be transferring, sharing, avoidance, reduction, and acceptance. So these are the common forms of it, right? So let's look at in individual how each and every element will be considered when it comes to the managing of risk. Okay. Right. So this is about transferring or sharing the risk. So in its name itself, you will be able to understand that the risk can be partly or wholly transferred to a third party, or it can be partly, which is shared among the third party, and then you can further continue on that, right? So I'm going to read this again. Risk can be transferred wholly or partly to a third party in certain circumstances. So there are certain circumstances. It's just not like you have a business and you have, so there are so many risks, then you just move the risk to someone else. That is impossible. You can't do that, right? So you just it's not about factoring I'm talking about. That's a completely different thing, right? But this is different. You are sharing or transferring your risk. Let's see how that happens. So, partly in certain circumstances, so that the third party would bear the total loss or most of it. This risk can be externally transferred to suppliers, customers, or the insurer. So, as customers, if you put your point of view as a customer, now you see where the price, what's the reason for the prices being high. Okay, it's because of the increase in risk that the business would face. Some organizations may transfer their exposure to strategic risk by sharing them with a joint venture partner or franchise. Maybe the organization is going on a loss. They're going on a loss because there are risks involved and they do not know how to manage it. So they would go into a joint venture because the other party would have more resources and would have the capabilities in dealing with that, right? Or franchise. Or what you do is there is risk, basically the financial risk. It can be transferred onto the consumers in terms of higher prices. So this is what happens when it is about transferring or sharing of risk. Through this way, the management of risk is done. So you charge more, the price is charged high, you get more income, and you are able to sort the expenses that are out there, which has been there a long time but cannot be covered. Okay, so this is about the transferring and sharing of risk. So this is one of the methods of risk mitigation strategies or techniques, right? Right. The next one would be avoidance. So English term avoidance is just ignoring, avoid it. Okay. So let's look at how the risk management or mitigation technique works in this way. Organizations may choose to avoid risks altogether. But before concluding such decisions, the company should see that the possible savings from the losses avoided are greater than the advantages that can be gained by not taking any measure and running the risk. In normal circumstances, the risk avoidance strategy is likely to be followed by organizations with a low risk appetite. Example, a new project with a very low likelihood of success will not be started. So that is you avoiding the risk. Okay, so there is less damage in that case, right? Maybe there would be less sunk cost because it's a new project. You've not gone to an extreme where you have to deal with it or where you have to make some profits in order to manage it. There's no such instances like that. So therefore, in that case, the risk can be avoided. So you, as a business, you need to be careful in understanding on what stage it is and how it can be avoided. Because, of course, if you go beyond a certain point, You cannot avoid the risk there, and you need to deal with it. So this is something that you can do at the start of it, and you need to analyze whether it's okay or not. All right, so that is one of the risk mitigation techniques. That's about avoiding the risk. The next would be reduction of risk. Often risks can be reduced in part and not avoided altogether. Of course, the examples of risk minimization are as follows. Risk minimization, this is where controls are implemented that may not prevent the risk occurring but may reduce the impact in case it occurs. So this is about minimization of risk. So it cannot be avoided completely, but of course you can like minimize the risk, right? So that is about this. Reducing financial risk. Hedging is a technique that would either neutralize or reduce the risk. So this is one of the techniques. Hedging is a technique. Then pooling risk. Under pooling of risk from different items are pooled together, each potential risk has its own upside and downside risk. This is best evident in investment in shares, where it would be wise to diversify the portfolio of investment rather than investing the total amount in one company only. So this is of pooling of risk. So you are not dependent on one sector or one company only. Instead, you invest in different areas. So even if one sector goes down, you still have profits being made on the different other sectors. So in that case, your risk is reduced, right? So this is about the pooling of risk. And then finally, we have acceptance. So the final strategy is to simply accept the risk. The company would decide to deal the consequences in that particular situation. This would normally be practiced only if the adverse effects are normal. Example, there's always a risk of rain unless the business activities cannot take place when it rains. Then a risk of rain is not normally insured against. Right. So here you do not complain on against it, but however, you accept the risk and you move forward with it. Right. So this is also one part of the risk mitigation technique. So these are the main concepts when it comes to theoretical explanation. If you have to show academic knowledge, for example, you are selecting an organization, they ask you to analyze the risks involved and the ways in which it could be managed. So this is basically, we say, your assignment question, right? So you should know how to tackle it. You should know to first address the different types of risks in the organizations. Once you have addressed the different types of risks in the organization, then it's about risk management or mitigation. So in order for you to explain further, theoretically and academically show academic expansions and so on and forth, you need to show academic writing in terms of the risk mitigation techniques or strategies. So you can address these elements and then you can further elaborate. Then after addressing the theoretical element, then you move on to applying it to the organization. So once you've addressed the risk in the particular organization of your choice, you are talking about the risk mitigation strategies. Once you have addressed the risk mitigation strategies, then you are connecting how it could be merged in terms of the chosen organization. Okay, whether it's going to be accepted, or it's a reduction, or it's an avoidance, or it's a sharing or transferring. Okay, so that is how you build your assessment. So that's the main reason why you are actually, addressing all these theories, because if not, you don't have to have a theory, you can just write it. But it's important that you show theoretical knowledge, provide the relevant citations, and then further move on to applications. Okay, so that is about the risk mitigation techniques. So here we look at the exchange rates, because there could also be risks in terms of exchange rates. I'm sure I would have discussed this in the last class, because that's one of the risks, when it comes to trading in the international markets, because you'll always have this risk where inflation taking place. For example, you are in a country based where the inflation rate is really high, so the value of your currency is really less. So if you are involved in trading with an international company or international consumers, maybe, or suppliers, right? So what happens is your value is really less. So when you are trading, in that case, the exchange rate will be really high. You're not making any profits in that sense, right? So that's going to be a problem. So let's look at this. Why is the foreign exchange market important? The foreign exchange market is used to convert the currency of one country into the currency of another, provide some insurance against foreign exchange risk. The adverse consequences of unpredictable changes in exchange rates. The exchange rate is the rate which one currency is converted to another. Events in foreign exchange of a market affect firm sales, profits, strategy, and not just the multinationals' parents. Right. So there are certain consequences when it comes to exchange rates, because especially when it is, you're dealing with developing and developed countries. Most of the times, we've discussed in this first class about globalization, the benefits of globalization, and so on and forth. But exchange rate is something really important in an organization. I mean, in a country, if the organization is involved in exporting, that's a different case. Your money inflow. But if you're importing goods from there, you need to be very careful about the exchange rate calculations, because you cannot pay more and get and then keep your profits and sell more here, which is going to be not very profitable. People are not going to look at that. Instead, maybe they would find ways of, getting it direct from there. There's no middleman involved. Maybe there are relatives who live abroad, they can bring them. Those are free and there are no exchange rate complications. So those things need to be very well understood by businesses when they are involved in international, trading with international markets. Okay. How are exchange rates determined? Exchange rates are determined by the demand and supply for different currencies. So usually any sort of a rate, it would be determined through the demand and supply. So this is one of the main studies in economics. So if you are producing something, maybe say, maybe you are producing a sort of a pen or pencil or something like that, right? Maybe it's a type of a brand. You need to first understand what sort of a demand is there, and the supply, of course, comes into place. When the demand is more, of course, we can charge high. It's okay. But however, if the demand is less, you need to charge less. So there are fluctuations taking place. So currency is also the same. Exchange rates are determined by the demand and supply for different currencies. Three factors impact future exchange rate movements: country's price inflation, the country's interest rate, and market psychology. Okay, market psychology is a very well known topic, and it's very interesting too, because that's about the preferences of the people and the taste of the people, the ideas of the people, the culture. All those things comes into place. And then how are exchange rates predicted? Fundamental analysis draws upon economic factors like interest rates, monetary policy, inflation rates, or balance of payments information to predict exchange rates. So these would be the analysis which would be done in order to predict the exchange rates or even the flow of currencies. Usually when a country is going at a very bad state and they want to, like, businesses who are involved in uh, international, buying and selling, they would always want to predict the exchange rate, because it's about planning, the next planning. right? So all of these elements would actually help the business to predict their exchange rates. Technical analysis charts trends with the assumption that past trends and waves are reasonable predictors of future trends and waves. For example, in a country, the central banks, like, the main banks, the government banks and stuff, they would have the predictions. So always the businesses would go in there and see the analysis, because every day the exchange rates keep changing, it keeps fluctuating. So the businesses are always on the lookout to see how the change happens. They'll see, okay, this week, last week's trend was, the rate was like maybe like 1 or 2% increase and decrease. So they would see the economic situation, the political situation, the interest rates charged, the demand and supply of the currency. So all these things will help them to come up with analysis and predictions as to what sort of changes that would take place for the next week. Right? It's actually not a long-term planning that would take place, but some sort of an analysis and planning would take place on a short duration, so which would help the businesses to make effective strategies and plannings. Okay. Right. So this is about what do exchange rate mean for managers. Managers need to consider the below types of foreign exchange risk. Transaction exposure, the extent to which the income from individual transactions are affected by fluctuations in foreign exchange values. So these may include obligations for the purchase or sale of goods and services at previously agreed prices and borrowing or lending of funds in the foreign currency. So these are transaction exposures because there could be instances where you agree with a transaction to be done now for the current exchange rate, but it's going to take some time to happen, or maybe the reaching of the good may be a bit delayed. So in that case, you are agreeing to a transaction to be done at the current rate and not at the future rate. Translation exposure, the impact of currency exchange rate changes on the reported financial statements of a company concerned with the present measurement of past events. Gains or losses are paper losses and they are unrealized. And then you have the economic exposure, the extent to which a firm's future international earning power is affected by the changes in the exchange rates. So these are the economic changes concerned with the long-term effect of changes in exchange rates on future prices, sales, and costs. So because of the economical changes, there is a change in the exchange rate which is affecting the transactions of the business. Exchange rate risk. This is also known as foreign exchange risk or currency risk. Exchange rate risk is the financial risk of an investment's value changing due to changes in the currency exchange rate. So this is about you invest something now. For example, you have there is a company A. You're investing in the company, right? At a certain exchange rate. With time going, the exchange rate is falling down. So what the earnings that you are getting in comparison to the investment you did is very less because of the exchange rate dropping down. Okay. So this is an exchange rate risk. In other terms, this is the risk an investor faces when he needs to close out a long or a short position in a foreign currency at a loss due to an adverse movement of exchange rate. So when you have invested, the rate was really like you had like lower inflation or you had a good standard. But later on, there has been inflation taking place, and because of that, the comparison rate is really high. You need to pay more to get what you were getting before. So in that case, it's a loss for the organization. Okay, so that's about the exchange rate risk. So this is the reason why when a business is trying to trade with an international market, it needs to make sure that the political stability and the economic situations are all proper. If there is some sort of an instability, that's going to actually affect the overall transactions and the operations of the business in the longer term. A good understanding about exchange rate risk is important as it affects the amount of money an investor actually sees at the end of the day. This will ultimately determine the rate of return for investors. So the concepts of exchange rates, there are many factors affecting decisions about exchange rates. Hence, there are many concepts relating to exchange rates, such as quote, cross exchange rate, spot and forward rate, premium and discount, which offer and bid. So we also have here, how can managers minimize the exchange rate risk? This is about the exchange rate risk minimization. So that's about buying forward and using swaps. Lead and lag payables and receivables. So lead strategy, attempt to collect foreign currency receivables early when a foreign currency is expected to depreciate. So at the time of depreciations, it is collected. So it doesn't leave for the worst stage to come. And pay foreign currency payables before they are due when a currency is expected to appreciate. Lag strategy, delay collection of foreign currency receivables if that currency is expected to appreciate, and delay payables if the currency is expected to depreciate. So it goes vice versa. Then we have the exchange rate risk. How can managers minimize exchange rate risk? To reduce economic exposure, managers should distribute productive assets to various locations so that firms' long-term financial well-being is not severely affected by changes in exchange rates. And you ensure assets are not too concentrated in countries where likely rise in currency values will lead to increase in foreign prices of goods and services the firm produces. So this is about analyzing the country's situations. How can managers minimize exchange rate risk? In general, managers should have a central control of exposure to protect resources effectively and ensure that each subunit adopts the correct mix of tactics and strategies. So they will have different branches everywhere, but the manager has to make sure that the central information is provided to all the subunits. You distinguish between transaction and translation exposure on the one hand and economic exposure on the other hand. Attempt to forecast future exchange rates. So this way you are able to do some sort of a planning and mitigate the risk that would come up. Establish good reporting system so the central finance function can regularly monitor the firm's exposure portion. Produce monthly foreign exchange exposure so you know what you are going forward for. Interest rate is the price of money which is lent or borrowed. It is usually calculated on an annual basis and it is expressed as a percentage of the sum. For example, if ABC buys a government bond and thus lends money to the government, they will receive interest. In this case, it is calculated on the purchase price. So they are getting income out of it. Generally, the longer the time period of a loan, the higher the rate of interest given or charged because of the greater risk and uncertainty involved because people might go out of paying. Changes in interest rates affect the economy in many ways. Main effects of an increase in interest rates are spending falls. People will not borrow, right? And then asset value would fall. Market value of financial assets will drop. Foreign funds are attracted into the country because they are going to get more returns out of it. Exchange rate increases and inflation falls on. Why does that happen? Because there is more inflow of foreign currency coming into the country. Okay, this aspect we've already covered on the first sections where we were talking about currency inflow and outflow, the economic situations and so on and forth. So that is what is connected in here. So right, this is about the section we've studied. So I'm going to now, 1 second. So I'm going to show you guys the video now. So with this, we are covering up the learning outcome 6, and the next class we will look at the learning outcome 7. So I'm gonna let you guys have a go through of this video now. So that is about today's session, guys. And so I hope you guys have had a look at the video too. Um, so we've covered so far about all the elements with regards to risk and the mitigation techniques and so and forth. So in the last, I mean, not exactly the last, but then it will be a last learning outcome. We will be looking at the potential investment decisions and the global strategies. And then, like I said in the last class, we can also discuss through the assessments, so which we will do. So yeah, I will see you guys in the next class, and then we will continue further with this.